If you have money in the stock market, you might want to watch this video. Today I'm going to talk about why stocks crashed after the recent Fed meeting, and whether this is a dip buying opportunity or whether there is more pain ahead. Expect to learn why stocks crashed despite the Fed pause, why I think inflation could prove more resilient, why I think this is actually a great dip buying opportunity, and how and when I expect a real stock market crash to happen. Because I do expect a much larger stock crash to happen later on. So just to recap, stocks crashed on Wednesday after the recent Fed meeting. Now, even though the Fed held its key interest rate at the same level, essentially pausing, markets didn't take the speech by Jerome Powell very well. Why? Well, if we look, for example, at the probabilities of a rate hike in the next meeting, the market is pricing much higher probabilities of a rate hike. Now, this is also clear if we look at the Federal Reserve dot plot. Now, this is a dot plot where all of the board members of the Federal Reserve put down their assessment of where rates should be by year end. And as we can see, a lot of the Fed members, a big majority, expect at least one more rate hike by the end of the year. So even though we got that rate pause, the hawkish tone of the Federal Reserve indicates that they might not be done yet. And this is something that the market wasn't necessarily pricing in. Now, another big reason why we could indeed get another rate hike is because of persistent inflation. And we have a clear example of this if we look at our neighbors to the north, Canada. Now, the Canadian Central Bank has talked about possibly raising rates in October given sticky inflation. As we can see, inflation has been climbing over the last 3 months in Canada. And why is inflation proving so sticky? Well, obviously commodities are going up. Oil has been making headlines as crude oil approaches about $90 a barrel. And we also have, as we can see here, a lot of inflation happening in other goods such as sugar and orange juice. So as we can see, Canadian rates and US rates have typically moved along quite close together. So if the Canadians do indeed raise rates again in October, then it's very likely that we'll see the Federal Reserve do the same. But why are we seeing commodity prices go up and inflation remain sticky? I think there's at least a couple reasons we can attribute this to. For one thing, financial conditions have actually loosened since about March. When we had that regional bank crisis, the Federal Reserve extended loans to a lot of these regional banks. Through the Bank Term Funding Program, we have re-injected liquidity into the system. On the other hand, we can also see that another source of liquidity for the market is the reverse repo facility. Now, the reverse repo facility essentially allows banks to give cash to the Federal Reserve and obtain treasuries in return. Now, as we can see, the usage of this facility has come down, which is equivalent to the Federal Reserve giving more cash to the banks. So this line going down in the reverse repo facility is actually an indication of more liquidity entering the market. This can actually also explain why, for example, we see this disparity between what can be described as global liquidity and the path of the SPX in recent months. As we can see, markets have been trending higher while global liquidity has trended down. So while the Fed has been raising on the one hand, it's also been giving liquidity to the market, which kind of explains why inflation has been resilient and why markets have also trended higher. With that said, what can we expect during the next few weeks? Is this a dip buying opportunity? Typically, as we can see in this graph, markets tend to rise as the Fed pauses. So even if we do get another hike, which the market is not pricing in, this could be a great dip buying opportunity. Not only will the Fed be pausing its rate hikes, but we still have liquidity from the reverse repo facility, and we also have some of the large central banks, such as the Bank of China, beginning to push out global liquidity. So I think we could definitely start to see a trend up. Now, this actually lines up quite well with my Elliott wave analysis, by which we should right now be completing a wave 4. Now, if we take the length of the wave A and measure from the top of B, so that A equals C, we should get a target of around 4,200. This is also where we get the 200-day moving average coming in, and I would definitely say this is a great spot to buy. Now, of course, following that wave 4, we should get a final wave rally in wave 5, perhaps targeting about 5,000 or even 6,000 SPX. Of course, following this, I would expect a major crash to happen in markets. Like I said before, the actions of the Fed today are setting us up for more pain tomorrow. As financial conditions are tightening now, the consumer is starting to feel more and more pressure. Now, for the moment, we still have pretty low unemployment and a lot of excess savings, but this is slowly getting depleted. My expectation is that in a few months, not only will we have depleted the reverse repo facility, which has been a good source of liquidity, but US consumers will also be at a point where they'll have to tighten their belts. They'll be facing much higher commodity prices, also much higher mortgage rates, At this point, we'll begin to see the effects of today's tightening start to take hold on the economy. We're already starting to see some signs of this, as we can see with credit card delinquencies. But I expect this to be felt also in mortgage rates and also in the general excess savings of the consumer. So that pretty much sums up my vision for the moment. We had a small crash, which I consider a dip buying opportunity, and I expect the economy to continue to be resilient and rally during this Fed pause, maybe for the next 4, 5, 6 months, who knows, maybe even into the elections. However, it's undeniable that at some point we're going to feel the pain from all this monetary tightening. We're going to run out of liquidity just at the time when consumers need it the most. At that point, the Fed will be forced to cut rates, and as usually happens, this new cutting cycle will be accompanied by a new bear market. So I hope you enjoyed this analysis, and if you like this type of content, I highly suggest you check out my Substack. I do a free weekly newsletter on Mondays, and I talk about everything related to macro, do a lot of technical analysis, and a lot of other great stuff. So thanks for listening, and see you on the next one.